Welcome to On the Edge, a show examining how deals actually happen in commercial real estate. Host Malcolm Davies, founder of Jofa Capital, speaks with professionals in development, investment, finance, and more for insights into how these business leaders get deals capitalized. Malcolm's career spans more than 20 years, during which time he has managed nearly $20 billion worth of financings. Now to your host, Malcolm.
All right, everybody, welcome to the next edition in our podcast, On the Edge. Got a great friend with me today, Jackson Brissette with Jofa Capital. And Jackson, I want to welcome you to On the Edge.
Thanks, Malcolm. Great to be here.
So, as we usually try to do on these podcast sessions and the like, is really, introduce the world to unique capital sources and people that are doing very unique things in the world, particularly as we've seen in an ultra-changing environment. But first, before I get into this, I want to put and send my hearts to all of the remainder Angelinos that are going through a hard time here. It's been a really difficult last few weeks. And so, on behalf of Jofa Capital and Jofa, we want to send our best to all of our friends and colleagues who are going through a lot in this time. So on that note, I think we can chat about some things about real estate and the like, but heavy heart for all of us. Okay. All right, Jackson, here we go, bud. Let's get into the kind of the world of how you think. So how did you end up kind of starting Jofa and just maybe give the audience a little bit of your personal background and the like?
Yeah. And first off, that was great. Thank you for saying that. We hope the Jofa Capital team is safe and everyone's okay and the rest of the Angelinos. So thank you for that. So I've been in real estate for 13 years. I went to UW-Madison, majored in the real estate and finance program, and spent most of my time in like typical private equity, started at Heitman, and then kind of went like the development route and moved to LA in 2019. And I've always been very entrepreneurial and just kind of a deal hound, as they say, and love niche product types. And ultimately decided with my partner, Brian Novak, who went to UW with me, that we wanted to start a firm that was really intellectually curious and not your typical operator who, capital says, hey, you guys do multifamily stick-built Orange County, right? Or you do small bay industrial. We wanted to focus on finding unique deals that the market doesn't see, that are very, very hairy and complex and require intellectual capital, maybe, rather than true, dollars capital. And so a lot of our deals have unique asymmetric outcomes where you have to solve a litigation issue, or you have to remove some encumbrance or some title issue that other people just weren't really able to see or extract. And it's not necessarily like you come in and buy this and you have to add 50 million in CapEx and then you can maybe lease it, right? We just don't love those deals. So we wanted to do something that was product type agnostic and market agnostic, but solely focused on what we call funky and fragmented deals. So we wanted to come into the office every day, just working on weird and wild stuff. And I think we're doing that. We have 3 deals now in a little less than a year. So it's been fun. I
love it. So you hear me a lot say this. I stay away from the words hairy, complicated. I just say it's sophisticated. So that's what I've come up with, sophisticated deals. So, on that note, let's talk about those deals. You've been involved in some really interesting, deal flow in that first year. Obviously, yours and Brian's backgrounds are pretty interesting, kind of lends itself to these types of opportunities. But maybe chat about some of the higher profile nature of some of these transactions. I think it'd be great for the audience to understand what you've already been doing.
Yeah. So our first deal was a Chapter 7 bankrupt airplane hangar / R&D building at the Hawthorne Municipal Airport. That was our first bankruptcy deal. So it was a true Chapter 7 liquidation. The debtor got into some trouble with prior sort of neighbors and selling fuel, and then some kind of, shady people in the South Bay who were essentially stealing money from him, unfortunately. So it was an unfortunate situation, but he was forced into Chapter 7 to liquidate the asset. And we just started high level and said, this is an incredible asset. It's located in the middle of SpaceX and Tesla, has runway access with a through the fence agreement, but it was a fee simple asset, which was super rare. So it checked all the boxes of being great real estate. And it turned out to be exactly what I described, which was we haven't spent any money on the facility. and we're leased 100% to a Fortune 100 company, clipping a 12% return on, our money, unlevered.
Wow, that's amazing. And I guess the question really is, how did that deal get to was it through the brokerage advisory shops? Was it something that you uncovered because you were focusing on deal flow that had gone into Chapter 7s or Chapter 11s or whatever it may be? How did that actually happen?
Little of both, sort of through an attorney relationship, as well as the property was actually being marketed for sale through a broker, sort of a, local South Bay, non-JLL, CBRE,
Sure.
sort of bigger name broker or advisor. And we just sort of saw it once we found out that it was in bankruptcy from our attorney who gave us the story. And as you know, with bankruptcy, it's all about the story and the saga, right? And this one had a saga. And we just realized, okay, on its face, this deal might trade an efficient price. But with the litigation, with the bankruptcy, we felt like there was a real angle at a basis, that we could feel attractive at an entry point. And we submitted an offer, became the stalking horse, which in bankruptcy is kind of the same as a normal real estate deal, other than you have to go to auction and win, which we did.
Right.
But, we felt like our basis, if you exclude, so we thought about it, we bought it for 13.3. The way we thought about it was if you exclude the fuel farm, because we had a fee simple fuel farm where you can sell fuel.
Sure.
Which we valued just at replacement cost. It cost $3 million to build that fuel farm, right? So let's say your basis is $10 million. We were sub 220 a building foot for a 40-foot airplane hangar with an R&D building, some ancillary space, fee simple with runway access. We were like, this is, when we find good basis deals, we take a run at them quickly.
Sure.
And that was a great basis.
Would you? I think in today's environment, I think basis is pretty much it's the everything. No matter what you think about how performance is, I think we're seeing obviously a lot of resets and all commercial real estate values have kind of reset to a certain extent. In that regard, you are getting opportunities to acquire things that historically low values but extremely high cap rates, which leads me to ask you a question I know everybody asks me is, what's your take on just generally investing in the office market? Obviously, you guys have invested in a lot of esoteric. I mean, when you buy a hangar, by the way, Hawthorne is an incredible airport. If anyone doesn't know, it is literally Main in Southern California. And so amazing acquisition. I'll get into what you're going to do with it going forward. But what do you think about asset classes today? Like, give the profile of things that you see, ranging from the most impaired to the kind of maybe more efficient. What's your thoughts?
So, yeah, we're product type agnostic. So I find myself in the bankruptcy world looking at all different product types. Pipeline wise, we're looking at a food manufacturing facility. We're looking at a marina. We're looking at a steel mill. So we look at wild stuff. That's on like the esoteric side, like you said. Yeah. But then we look at industrial and retail. And I like retail a lot right now. We look at multifamily. I find multifamily in California right now just hard to pencil to opportunistic returns, which we target. So office. I have a deep history in office, and I always liked the product type. It's a fun product type to work on. I just find right now on the capital side, it's such an uphill battle that unless I have a unique market angle, know something about the asset that other people don't, or have an extremely unique business plan or a tenant in tow, I don't have the time to do that uphill battle with capital. Yeah, and I don't really want to stick my neck out and tie up a deal without capital behind me on an office deal like that. So that's what I would say about office. I've been talking to some people who are dipping their toes back in at exceptional bases, land bases, right? So I'm looking at it, but I would say that's kind of my main problem right now is the uphill battle without some like really strategic, unique angle, which I'm sure you're hearing a lot.
No, it is. I mean, the things we've been doing in office are really repositions, right? So transitional and changing it from alternate use. So we did a couple deals in San Diego, one converting to a hospitality asset, another converting to for sale residential, which is super unique. And the basis is why both of those can actually work, because it's a lot of work to transition an office asset, of course. But the reality is it's really an impaired asset class. And frankly, on most deals today that were capitalized or acquired or built in that 21 era, we all know are struggling if they have not stabilized yet, right? The reality is the difference between a stabilized asset today and the debt markets versus an unstabilized asset. No matter what's happening with short-term rates, long-term rates are up, and values are continuing to be impaired because of those rates escalating, right?
Right.
Maybe Jackson, talk about like geographic thoughts. You're obviously doing things that are niche. You will get in there on things that maybe others won't through bankruptcies and the like. But are you like most investors today thinking about the Southern Smile States? Are you thinking about anywhere? You mentioned some things like steel mills and things like that. But what's your thoughts about geography?
Jofa's market agnostic, except for targeting places that have more than 50,000 people. So we are truly focused on the deal story and yield profile. As far as ideal locations, I would say we like to be within driving distance to our deals as operators. So
Sure.
I live in Madison, Wisconsin, which was a recent move, opening an office out here in the Midwest, and still forming our Midwest thesis on markets we want to target and invest in while remaining market agnostic. And then Brian's in Santa Monica. So our deals right now are in San Diego, Hawthorne, and Riverside, all driving distance. So that's ideal for us in California. And we find ourselves looking at Phoenix a good amount. We look at deals in sort of the Pacific Northwest as well, and then Texas and the Southeast, as you mentioned, Florida. So yeah, market agnostic and try to be local, but being market agnostic is hard to be local sometimes.
Agreed. Not to pivot a bit, but I like the name of the company. What is give us the backstory of the name. So it's always good. It's got to have something to give me the angle. I want to know what it means.
So yeah, Brian and I are both hockey players, and his company prior to Jofa was called Sherwood, which is an old school hockey brand. They made like old school wood sticks. And Jofa is an ode to a now defunct Swedish hockey brand that like Gretzky wore back in the 80s.
I love it. So that's
and a lot of it was, as you know, it's hard to start your own company and find a domain that works. So we thought 4 letters. Once people know how to say it kind of rolls off the tongue. Jofa, what are the Jofa guys up to? So yeah, it's nice. And we got the hockey ode.
I agree. When I started Way, I was I came up with this brand name, and it was We Are You, and then I was like, okay, that can be an acronym, and so and then I thought about it. I'm like, the only thing I didn't think about was that having 2 syllables is actually a pretty good one. So some people call it Way Cap or whatever, but it's not easy. I'll give you credit. So it's not easy to come up with a name because all the other colors and rocks and things are taken today. All right, so you got an Inland Empire deal, a San Diego deal. What are those 2 in the portfolio?
So the Riverside deal is a 10-acre gravel yard that operates sort of like a mini yard. So you've got I think we've got 20 tenants, all like 10 to 15, 20,000 feet of land. It's 10 acres with an asphalt through street with side suites lining the north and south. So it operates very efficiently for those smaller trucking guys, pallet guys, crane guys, etc. That deal was funky and fragmented. We were able to find through an attorney a TIC interest coming for sale because of a divorce within the trust. So the project was owned by one single trust, of which 2 families operated both sides sort of separately without talking to each other. One side was a divorce of 2 91-year-old people, if you can believe it. That 25% TIC interest was coming up for sale. We bought that at the courthouse steps while simultaneously contracting for the remaining 75, which allowed for an exceptional entry basis. We bought it for basically $15 a land foot. When comparable trades, both now and prior to interest rates going up, were anywhere from 30 on the low end to 75, 80 on the high end. So we felt really great about that. Current, without putting any money into the buildings and just marking our tenants to what we call affordable rents, not market. Yeah. So I think we have another 25, 30% to go. We're at a 10 to 11 cap unlevered yield.
Amazing. Yeah. So look, I think part of what I'm seeing you guys doing is you're looking at things. Sounds to me that you're looking at a lot of the deals, and not that you're unlevered, but that you're really focused on what your unlevered basis is. That really is, to the audience perspective, that's really truly the way that you can make sure you've got a great deal, because there's not a lot of financial engineering that you're doing to really understand what that is. How are you structuring these deals? So obviously, as you know, we're a structured finance company. We raise money on behalf of real estate owners, developers, sponsors, and the like. And Jofa itself can do deals direct. It can do deals in partnerships. It can do deals in a structured equity investment, which I think is a lot of where the next market phase might be. But talk about, like, are you pretty agnostic to structure? How are you thinking about this?
I would say 80% of Brian and I's time finding deals is on the common equity side.
Yep.
However, given our product type agnostic focus, as well as the deals we see, oftentimes we've found that we're able to find interesting, unique debt opportunities given our equity lens, and finding deals that maybe it's super off market and the capital needs of the owner or the sponsor we're talking to really align more with restructuring the balance sheet and sort of a complex financing execution. So we've aligned with some strategic capital partners and said to them, we're not really going to send you like marketed blasts from, debt advisors. Although I have done that on some of your deals because you find really cool deals. So you're maybe the exception. But we try to, show our capital partners on the debt side deals that have come through the equity lens. And they can't say, oh, I've already seen this from JLL or whomever. Right. So we try to tailor solutions, as I'm sure you do, based on how we're looking at a deal and trying to get in the weeds on what's really happening, who's the current owner, what do they really need. So it is first and foremost common equity, just because that's where Brian and I can, sort of create the most value, we feel. Yep. But we do love sort of playing in that middle market, structured, tailored financing solution, especially if we can also be aligned with maybe the current sponsor and help out on the asset management side. Then we really feel like we're adding a ton of value rather than just sort of, finding a quirky deal and facilitating it.
And a lot of times, when we're trying to solve some challenging situations, we're talking about how to bring in not only groups that capital's coming in, but they're also bringing in execution expertise and operational expertise. And in that situation, we always say, look, the reality is, sometimes people aren't just going to give you X dollars, 10, 20, $50 million, and then, hope that it's going to work out. They tend to want to work with the operating partners that they have worked with for years because they are taking a significant amount of risk. And so we create those marriages between ultimately an operating partner and another operating partner, but that gives the comfort for someone to really come in with that capital. In that situation, that's a win because they didn't have the ability to bring that capital in because they didn't have that relationship like you just mentioned.
Exactly. Yep.
All right. So just in general, over the next 5 years per se, like on the assets you have acquired, what is the business plan? What is the disposition of these assets going to look like? How do you guys see? Are you waiting for more visibility, clarity, liquidity, asset, cap rate compression? What's your perspective about the latter part of this decade?
So first off, on all of our deals, we're trying to create business plans that we can exit within 2 to 3 years.
Got it. Okay.
Really one, right after cap gains is kind of the goal. And, we've talked about this before. A lot of our deals, we have sort of these 6 or 7 things that we look for. One of them is finding deals that require, time capital, not actual capital, as we discussed, and that can be where that value can be extracted somewhat quickly, where you're basically like fixing a situation. So 1 to 3 years for our deals. I think what's happened is, as you mentioned, we've been very focused on buying deals unlevered, so we have that flexibility. So I think what we're seeing is fix it and then refi and then sort of explore that sale scenario with the right. Is it a 1031 sale? Is it a strategic, on the hangar? Is it a hangar aggregator like a Sky Harbor? And exploring those, but refining and stopping the clock on our equity, right? And having that flexibility. That's kind of a really key thing for Jofa is finding those deals where we can stop the clock and not have to rely on our business plan on, well, we're going to sell it in 5 years to a 1031 buyer and have that market be perfectly priced. So that's huge for us.
I think you're seeing that come back into commercial real estate. I mean, we lived in a low interest rate environment for north of a decade, right?
Mm-hmm.
It was unbelievable if you really look back at historically, being able to look at something and then reposition it without the pressure of debt exposure while you're repositioning that asset is truly, it's a blessing to have. And a lot of people don't get the ability to do that. And so for you and your capital partners to come into that kind of an opportunity, it really is a competitive advantage.
Yeah, we're super grateful about being unlevered, especially as a young operator, and just, lender requirements for closing and ongoing reporting. It's really nice just to know you're reporting wise dealing with just your equity partner.
100%.
And you can make decisions for the asset that are the right decisions for the asset, not, necessarily financial driven because of a loan.
Right. And so when someone's thinking about doing business with you, what would you say is between you and Brian and your backgrounds? How are you to work with? A lot of people ask me these kinds of questions, and is this one of these situations where you truly think of things as a pure partnership? Walk us through, because I think that's one thing that when we think about bringing groups together, it's really about people that get along well with each other. I mean, I think at the first, my advice is, if you don't like to see the name show up on the other side of that cell phone, call you, don't do a deal with that person, right? It's just, that's the way it is. They're not bad people. It's just that you don't get along. How do you guys think about that in your relationships with the groups you do business with?
I mean, that's super important from a sourcing perspective. I always say, and Brian says too, you want to be the first call, and that starts with just being well liked and also being responsive. I think I would tell people, I've just run into so many people in this business who aren't responsive, and it goes a long way to make a phone call and give feedback on a deal, whether it's positive or negative. And I want people to know of Jackson and Brian and Jofa as the people who will give them honest feedback quickly. And they're just, we're just nice, likable people. On the operator side, we are extremely focused on our communities and being at the assets. At the hangar, we moved our office to the hangar. We were there every day, going to Eureka, which is the bar restaurant on the field, meeting with our tenants. We'd have parties, sort of like little happy hours in the hangar before it was leased for our tenants. I got to know the airport manager extremely well, would stop into his office. Just those little things go a long way. And I think our equity partners know us as people who approach real estate the old school way of really being there, boots on the ground, rolling up their sleeves. Brian and I would weed whack the taxiway next to our hangar ourselves. Mm-hmm. We would go to it. We didn't want to hire a weed whacker. We would go there and do it ourselves because we just bought one at Costco and went and did it. But we also have an institutional background. So the Farallon guys who are our partners on 2 deals, they know that, we're going to be timely on our reporting. We're going to think about things the way that they do. We're going to be proactive. We're going to think about things before they do and bring up issues, solve things before they can think of it. But also be local, super hyper local stewards of our real estate. And I think that's what we try to do on every deal. And I think it goes noticed by our neighbors, by our community, by our LPs. So
I love it. You take the proverbial trash out too. I think that's what I always say. By the way, that's a good burger, by the way. Eureka is a great hometown team, hometown platform. Well, listen, Jackson, this is amazing. And I think just in general, we really enjoy spending time with good people. I've really enjoyed getting to know you guys, even from your previous platforms and what you're doing today. I think we're going to all be extremely busy in 25 because of where the market is. And we look forward to obviously bringing more and more opportunities to you guys and introducing you to the unique things that we're involved in. So Jackson, on behalf of Way Capital team, myself, can't thank you enough for taking a few minutes with us. And thank you. And one thing I'll leave you with is I love the Midwest values. So you bringing the Midwest values to commercial real estate is appreciated. So thank you, Jackson.
Well, thanks for having me, Malcolm. Really appreciate it.
All right. Have a great day. See you, bud.
All right, you too. See you, man.
Take care. Bye.
Thanks for taking the time to tune into our latest show. As always, you can find us through our YouTube channel at youtube.com/@wayontheedge or at our website at www.waycapital.com. Until next time, keep working on the edge.